Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Dynamics, AI Sector Update, and Q1 Earnings Review. This video presents a direct informational narration of the source document. Now, as we look ahead to earnings reports from the technology mega caps, the source document points out a fairly cautious capital sentiment sweeping the broader market. Rising oil prices and those climbing U.S. Treasury yields have really put the pressure on U.S. equities. As a result, we're seeing slight declines across the three major indices, along with a very clear divergence among the different sectors. Our agenda today covers macro overview and geopolitics, the AI sector and an OpenAI update, market structure and technicals, tech and telecom earnings, healthcare and airline trends, and we'll wrap up with software and transport earnings. Section 1. Macro overview and geopolitics. So the macro environment right now is being shaped by some very specific pressures on U.S. equities, primarily driven by rising international oil prices and treasury yields. And this dynamic? It's created a stark sector divergence. Tech stocks are declining broadly as capital sentiment turns cautious ahead of those major earnings. But in contrast, the oil and gas sectors, right alongside healthcare insurance, are actually advancing, buoyed by that upward trajectory of yields and oil prices. On the geopolitical front, the document details a slow-moving and honestly frequently obscured negotiation process between the U.S. and Iran. According to reports from the New York Times, the U.S. expressed dissatisfaction with a three-stage proposal. This proposal actually required the U.S. to first end its maritime blockade of Iran before even addressing the Iranian nuclear program. Previously, Iran had repeatedly rejected U.S. proposals to suspend its nuclear program and hand over highly enriched uranium. Furthermore, CNN reported that Pakistan, acting as a mediator here, anticipates receiving a revised Iranian proposal in the coming days. This follows the Iranian foreign minister's visit to Russia and subsequent consultations with domestic military leaders. Against this tense geopolitical backdrop, international oil prices briefly touched the $100 per barrel mark intraday. The source emphasizes that despite conflicting reports and all this diplomatic maneuvering, the market's fundamental focus remains strictly on the operational status and the physical passage of ships right through the Strait of Hormuz. Section 2. AI Sector and OpenAI Update. Now let's pivot to the primary catalyst for the day's decline in the tech sector, critical reporting surrounding OpenAI. A Wall Street Journal report cited in the source document detailed some specific growth deceleration metrics at OpenAI. The company reportedly missed multiple internal targets, including a plan to reach 1 billion weekly active users by late last year, along with some specific revenue goals. A key factor here is intensifying competition. Anthropic is capturing share in the coding and enterprise markets, and user churn is increasing due to the rise of Google's Gemini. Because of this, OpenAI CFO Sarah Friar reportedly expressed concerns to upper management that if revenue doesn't grow fast enough, the company might be unable to afford the massive expenditures required for future compute contracts. As you can imagine, this news reignited concerns over the return on investment and the overall sustainability of massive AI capital expenditures, right before the broader tech earnings season kicks off. It is absolutely important to note that OpenAI completely refuted the report. They stated that their advertising and enterprise businesses are actually firing on all cylinders and continuing to grow. But despite this rebuttal, core partners within the OpenAI ecosystem, names like SoftBank, Oracle, and AMD, all experienced immediate stock pullbacks following the news. The document contextualizes this by observing that the market impact of OpenAI partnerships has been diminishing since November of the previous year. To put that into perspective, since late 2024, a basket of stocks related to OpenAI has accumulated a gain of approximately 75%. Now that sounds great, but it significantly underperforms a basket of Alphabet-linked stocks, which surged over 300%. It seems the initial explosive market reaction to OpenAI partnership announcements has faded. This suggests that the Wall Street Journal report might have just served as a convenient catalyst for the market to lock in profits following a period of extreme FOMO, or fear of missing out, driven buying in the NASDAQ 100. Section 3. Market Structure and Technicals. This brings us to a crucial shift in analysis, moving away from fundamental narratives and looking at the microstructure driving current equity volatility. The source document asserts that the U.S. stock market right now is a highly financialized, engineering-driven ecosystem. While fundamentals remain the long-term anchor, the document states they've largely become just a backdrop for daily, weekly, and monthly volatility. Instead, it's technicals providing trigger signals for algorithms, while market positioning and systemic fund flows act as the true engines. Recent price action was heavily driven by institutional hedging, extreme short positioning by commodity trading advisors, and subsequent massive short squeezes, rather than any real shifts in underlying fundamentals. Looking at the technical parameters, Bank of America strategist Paul Ciana notes that the S&P 500 has broken through its head and shoulders bottom targets. That includes the 7,000 integer threshold and an extended target of 7,084. So the market is currently in a necessary consolidation phase, absorbing an expected $23 billion in selling pressure from end-of-month pension rebalancing. Bank of America expects this consolidation to be shallow. They've outlined a strategy to hold positions, but with a strict stop-loss set right at 7,000. Now, if the index breaks above 7,300, phased profit-taking should commence. The strategist actually projects a potential peak in the 7,308 to 7,377 range before a wave 2 downside correction risk increases during the summer, which would be driven by declining liquidity and approaching midterm elections. Section 4. Tech and Telecom Earnings. Let's transition into a rapid-fire review of individual corporate reactions and earnings reports, starting with the tech and telecom sectors. Following that OpenAI report we discussed, CoreWeave quickly responded, asserting that its fundamental demand remains totally unshaken. They clarified that their client matrix is diverse, encompassing Anthropic, OpenAI, Google, and Meta, and that AI compute demand still far exceeds supply. Conversely, Oracle dropped 4%, breaking below its 171 neckline. The source links this technical weakening to Oracle's $300 billion backlog tied to OpenAI. They note that if OpenAI cannot sustain its infrastructure commitments, Oracle's first-in-line risk would rapidly magnify. Looking at Robinhood's Q1, it was definitely a mixed quarter. Revenue hit $1.07 billion. That's a 15% year-over-year increase, but it did miss the $1.18 billion estimate. This was largely dragged down by a severe 47% drop in crypto trading revenues, though that was offset by a 24% rise in net interest income. Diluted EPS came in at 38 cents, missing the 46-cent estimate. A real bright spot, though, was Robinhood Gold, which added 1.2 million subscribers, pushing average revenue per user up 8% to $157. The document notes that the stock remains deeply tethered to Bitcoin's performance and Federal Reserve monetary policy. Moving on, Corning delivered a solid Q1 beat. Core sales were up 18% and core EPS jumped 30% to 70 cents. Their optical division surged 36% and solar jumped an impressive 80%. However, the stock saw a sharp pullback due to disappointing Q2 guidance. The Q2 EPS midpoint of 75 cents missed the 76-cent consensus. This was partially attributed to a $30 million one-time cost for maintenance and upgrades at their solar wafer plant. Additionally, the document highlights some insider selling, noting executives offloaded roughly 370,000 shares for over $33 million in the past 6 months. That's a factor worth monitoring, even with the company's strong underlying AI, data center, and solar growth drivers. We also saw ARM shares plunge another 8%. The downside driver here, according to analyst Ming-Chi Kuo, cited in the text, stems from rumors that Qualcomm is collaborating with OpenAI on a custom smartphone chip. Because Qualcomm is a core client, investors fear this new chip might completely bypass ARM's architecture, threatening future licensing revenue. And this was all compounded by heavy profit-taking following prior massive thematic speculation in the CPU space. Section 5. Healthcare and Airline Trends. Shifting focus, we see a really stark contrast developing between the resilience of the healthcare sector and some lagging transportation trends. Centene surged 14% to lead the S&P 500 components, fueled by a strong Q1 earnings beat and an upward revision of its 2026 EPS guidance from $3.02 to over $3.40. This really showcases a sustained valuation repair process. In stark contrast, airline stocks declined collectively. Bank of America data indicates that since the onset of the Iran conflict, ticket and baggage fees have surged. This has caused passenger traffic to slow down significantly, actually dropping below seasonal trends for both 2024 and 2025. The document suggests this traffic drop, driven by high oil prices, may serve as a leading indicator of weakening discretionary services consumption. Section 6. Software and Transport Earnings. Moving to our final segment, covering contrasting earnings results in the software and legacy transport sectors. First up, Spotify reported fundamentally strong Q1 metrics. Their adjusted EPS of 3.45 euros comfortably beat the 2.95 euro estimate. They added 3 million net subscribers, achieved a record 33% gross margin, and generated a record 824 million euros in free cash flow. Unfortunately, all of these strong metrics were overshadowed by a Q2 revenue guidance miss.
This triggered a massive 12.4% stock plunge, bringing the total drawdown since June 2025 to approximately 45%, as noted in the source text. This was further exacerbated by broader software sector valuation compression. General Motors presented a very different picture. Despite a slight revenue decline, GM reported an adjusted EPS of $3.70, significantly crushing expectations of $2.61. They also raised their 2026 full-year EPS guidance to a range of $11.50 to $13.50. This massive beat and upward revision were heavily driven by a favorable $500 million adjustment. This followed a Supreme Court ruling on tariffs under the International Emergency Economic Powers Act, which effectively lowered their projected total tariff costs for 2026. Finally, UPS exceeded Q1 revenue and profit estimates, but they disappointed investors by maintaining flat full-year financial guidance. This really contrasted with rival FedEx's recent guidance hike. UPS cited volatile U.S. trade policy and rising fuel costs impacting their domestic margins. However, management views Q1 as a key transition period, projecting a mid-year inflection point. Once they complete their Amazon parcel reduction plan, they expect to restore overall revenue and operating profit growth. As we wrap up this explainer, a critical dynamic emerges from the source material. With CTA positioning basically exhausted and market structures stretched, will the impending tech megacap earnings validate the ongoing AI infrastructure expenditure? Or will they serve as the fundamental catalyst that triggers the market's anticipated technical wave 2 correction? The resolution of this tension will likely dictate the very next major move in equity flows.